Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hi everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss 7 crucial steps to follow when you receive an inheritance. Specifically, I'm going to chat about the emotional impact of receiving an inheritance, the crucial first step that cannot be overlooked, how to build a team to help sort through your options, key considerations for married and common law couples, a typical financial importance hierarchy, and lastly, as always, action items for you to consider. Well, Happy New Year, everyone. I hope the first week of 2024 has treated you well and that you haven't quite skidded off those New Year's resolutions just yet. My wife and I are headed to Mexico at the end of the month for some much needed relaxation and fun in the sun. Well, more importantly, we wanted to spend some quality time together before we welcome our second child into the world this May. As you know, or as you may not know, I'm sure you've heard, sleepless nights await. So today, I will be navigating the complex planning process of receiving an inheritance and explore the emotional and financial dimensions that accompany the passing of wealth from the silent generation to the baby boomers. Now, the word inheritance carries with it a lot of baggage. Besides the obvious fact that someone needed to cross over in order for you to receive it, there can also be another broad set of emotions that are unique to this scenario. Oftentimes, when one receives an inheritance, they begin to relive a lot of past emotions, both positive and negative, that inheritance is tied to. Maybe it's the inheritance of a family cabin or antique car, or maybe it's just a dollar amount that represents a final gift to you. Either way you slice it, although we would all prefer our loved one to be present, this is a path we all must inevitably walk. With that, let's discuss the 7 crucial steps when receiving an inheritance. The first step is to take things slow. Your mental health and well-being should be your first priority. Everyone deals with grief differently, so take your time and do what feels right to you. Making large financial decisions needs to be well thought out and not done hastily. If you do have to make an investment decision in the short term, while you may be in a state of shock, be sure to consider a liquid investment like a money market fund, high interest savings, or just leaving it in cash. The second step is to check with the executor of the will. That is, if you aren't the executor. Here, you want to determine if there are any potential issues with the estate that need to be worked out in advance. Now, while most all estates will be settled and taxes paid prior to any distribution to the beneficiaries, there are instances where a beneficiary should discuss potential tax issues with the executor. One specific example would be in the event you or another beneficiary was named as a direct beneficiary on an RRSP or RIF. In this case, the money would flow tax-free directly to the beneficiary, while the estate is still liable to pay the tax. So let's discuss an example. Let's take Curtis and Jennifer and their elderly mother, Catherine. Curtis is the executor of Catherine's will, while both Curtis and Jennifer are 50-50 beneficiaries of Catherine's assets. When Catherine passes away, she has a $1 million RIF. In the RIF account, she has named both Curtis and Jennifer as 50-50 beneficiaries, meaning they will each receive $500,000 directly. But here's the catch. The estate is liable to pay a tax bill on the RIF, nearly $500,000 in tax, assuming a 50% tax rate. Curtis, as the executor, is liable to pay the tax of nearly $500,000 to settle Catherine's estate. Now, if his sister Jennifer took her inheritance, paid off debt, gifted, and otherwise spent it all, settling of the estate would likely need to come out of Curtis's inheritance. Now, I plan on releasing an episode in the very near future about discussing being an executor, so be sure to subscribe so you don't miss an update and the latest episode. So now that you have things squared away with the executor, the third step is to make a plan. Receiving a large lump sum, such as an inheritance, has the ability to alleviate a lot of stress, but can also cause a lot of friction amongst family members. So it's important here to take your time and map out the best route. Here, I would suggest engaging your financial planner, accountant, and lawyer. Your financial planner will be able to help you get organized and help you determine the best way to allocate your resources to pay the least amount of tax while achieving your other financial goals. An accountant will be another crucial professional to include, especially if there are tax implications involved, and I'll discuss a little bit more on that later. Lastly is to engage a lawyer to review and update your estate documents and discuss the potential need for an inheritance to be separated from other marital assets. Also, more on that topic in a bit. Engaging your team of professionals, especially when physical assets are inherited, should not be overlooked. Moreover, your certified financial planner should be the core professional to coordinate with your other professionals to align your finances and balance your best interests with your desired outcomes. Okay, so now that you've engaged your professional team, the fourth step is to determine if there is any tax that will need to be paid. Now, while there is no inheritance tax in Canada, there are a few scenarios to consider, such as inheriting farmland or vacation property. In the case of a vacation property, in the eyes of CRA, this property was disposed of at fair market value and taxes are payable by the estate. Any subsequent sale in the future, however, will result in a taxable event for the beneficiaries. So, for example, if you inherit a vacation property with a fair market value of $400,000, and then you sell the asset and receive $500,000, you will have a $50,000 taxable capital gain that will be taxable at your marginal tax rate. If you find yourself in the scenario of liquidating land or property, be sure to understand the tax implications and ensure you have enough cash uninvested to pay CRA their share. The fifth step is to consider the impact of commingling inherited assets with family assets. If the intent is to keep the inheritance separate, whether it be money or property, if you want to keep it separate from your spouse, you'll need to ensure you have clear documentation. While some may suggest simply keeping the money in a separate account, documenting and keeping proof, hoping that that would ensure the inheritance is not considered as a family asset, I think most lawyers would agree that this type of structure is highly contestable in the event of a marital breakdown. If it's important for you to keep your inheritance separate, I strongly suggest completing a marriage contract or cohabitation agreement if you're common law to protect your inheritance from a spousal breakdown. You will need to speak with a lawyer to complete these documents. The sixth step is to revisit your retirement plans to best determine how to allocate the inheritance to make some smart financial decisions. Here is a hierarchy of decisions to consider. First, if you have any mortgage or outstanding debt, consider wiping the slate clean and alleviate yourself from the last little bit of debt before you retire. Second is to keep some cash in savings for an emergency or an opportunity that arises in the future. Third, top up tax-efficient accounts like the tax-free savings account. Fourth, if there is some tax payable from a property sale, consider an RRSP or spousal RRSP contribution to offset the tax bill. Number 5, consider other tax-efficient investments inside of your non-registered accounts, also known as cash accounts. By this step, if you still have a large lump sum left over, you'll want to be very diligent on how your money is invested inside of the non-registered account, as there are different tax implications for different kinds of investments. Number 6, if you want to help the kids, consider having them open a first home savings account as a way to help them buy their first home while gifting some of their inheritance to them early. Check out episode 17 of my podcast for more information on the FHSA. And number 7 on the hierarchy of potential uses for the inheritance, if you have charitable intent, consider opening a donor-advised fund to help you and your parents create a legacy. Unlike a lump sum donation, a donor-advised fund continues to exist and provide benefit to the charities of your choice even after your passing. The importance and relevance of each of these financial steps will be dependent on your own financial situation. Okay, so the 7th and last crucial step to consider when receiving an inheritance is to do something in memory of your loved one. While things like paying off your mortgage and helping your kids out are important, I encourage you to think about your relationship with your parents and do something in their honor. It doesn't need to be big or extravagant. Maybe go back to Coffee Row and buy your late parents' friends their breakfast or make a donation to their old senior social group club. It may not seem like much, but even these small gestures are great ways to keep the memories alive. Furthermore, creating a tradition is a healthy way of remembering your loved one. It can provide you and your family with a way to grieve and recognize the person's life and their impact on you while allowing you to go on living your life. All right, so that does it for today's episode. Here are action items for you to consider. First off, if your parents are still around, give them a call. Time is a thief, and we never really know how much time we truly have left. Number 2, if you find yourself with a recent loss of a parent, take your time and process your loss before making any decisions, money or otherwise. And lastly, when that day comes, align your professionals and make a plan. All right, so thank you for joining me today. I appreciate each and every one of you through this podcasting journey. I've really enjoyed it. I hope you have as well. If you have been enjoying it, please subscribe, leave me a review in your favorite podcast app. If you haven't done so already, I really encourage you to sign up for my weekly Retiring Canada newsletter. Every Thursday morning at 8 a.m., I put some great content in there. If you like the podcast, you are sure to like those newsletters as well. And lastly, as always, hey, when it comes to your retirement, don't take chances. Make a plan so that you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.